Most investors see 17% yield and immediately think one of two things. Either, wow, it's incredible income, or there's no way that's sustainable. Today we're breaking down TappAlpha's TDAQ ETF, how it actually generates income, and then we're going to compare it directly to two of the most established Nasdaq income funds, the Neos Investments QQQI and the ProShares IQQQ. This is not about hype. This is about structure, risk, income quality, and each fund is really built for. Hey guys, I'm Doug the Retirement Guy. Welcome back to the channel with all the monthly ETFs. And we're doing a deep dive into TDAQ. This is a new fund that's come out, and we're going to show you exactly where it fits. Important notice to all investors, this presentation is provided for an educational purposes only and does not constitute financial advice. This is for educational purposes, no financial advice. Distributions are risky and are not guaranteed. If you need any type of financial help, tax advice, always contact a professional before making any type of decisions. So what is TDQ? And really comes into is this high yield dilemma. And this is what people have told us and they've asked, and I get the two different opinions every time. And they either say, wow, this is incredible income, or there's no way this is sustainable. And it's very drama effect that is the 17% yield of income potential a positive, or is just way too many risks to be sustainable. So we're going to take a look at TDAQ, and then we're going to take a look at QQQI and IQQQ to give you a better breakdown, because TDAQ uses the daily 0 DTE options. QQQI is a traditional covered call ETF. And then IQQQ is that rules-based derivatives. So we have three different ways of doing the Nasdaq 100, and we're going to compare all three. So let's start with the newest fund in the room, and that's the TDAQ, the strategy overview. At the core, TDAQ gives you exposure to the Nasdaq 100, but the income doesn't come from natural dividends. It comes from daily option activity. And here's the key difference. TDAQ uses daily 0 DTE calls, meaning options expire the same day they're written. That matters because time decay is the fastest on expiration day. So instead of selling monthly calls like traditional covered call ETFs, TDAQ is attempting to harvest small, frequent option premiums every single trading day. And that's how it gets its headline yield in the mid to high teens. Now, why they use daily options that changes the game. Daily options sound efficient and can be, but they also introduce new risks that investors need to understand. With 0 DTE strategies, income depends heavily on daily volatility. Option timing matters more than long-term trends, and results can vary significantly from month to month. This is not a set it and forget it type fund. This is a TDAQ is an active traded strategy packaged into an ETF wrapper. That can work, but requires skill, discipline, and favorable market conditions. When we take a look at TDAQ under the performance overview, check underneath the hood, we see that the assets already over $94 million. Now this fund has really been only out about a little over 4 months. So $94 million in assets, it's got a strong backing already. Has over 3.5 million shares, has an expense ratio of 0.68%. Now, of course, in only the past 4 months, it's paid $1.13 in dividends, or a 4.28% dividend yield. Now, it does pay out monthly. So when we look at the charts on the activity of the fund, and we do see it coming up, a little down, back up, a little down, back up. But overall, over the past 4 months, we've seen a 6% growth into the fund. The total return over the past 4 months is 9.94%. So the fund shows some real promising possibilities of potential being a very, very strong runner. Now, when we take a look at the long, big picture, that's where we get to that 17% that TappAlpha has put out there, that's what their long-term goal and plan is looking at. Now let's take a look at the pros and cons of TDAQ. Now, some of the pros: very high income potential, daily cash flow style of distributions. Now, that is not weekly or daily payouts. That is just cash flow coming in from those option premiums. So it's more frequent income delivery compared to a monthly or quarterly distributions. Effectiveness: it uses time decay as an advantage and as a tool. And the innovation focused of the Nasdaq exposure. It's direct exposure to the Nasdaq 100, giving you growth and technology and innovation leaders into the primary package. Now, they use the same exact fund as they do in the S&P 500 version, okay, and is shown that it's performed and done very well in multiple different markets. So there should be no reason why Nasdaq shouldn't do the same. Now, the cons: it's an extremely short track record. Okay, we got to be upfront and honest with you that we're looking at something that's only about 4 months old. So you don't know how this thing's going to act in a April 2nd drop off, a November market recap, is because the fund was so new at these point in times. Small asset under management. Now, yes, it's a small asset compared to what we're comparing it to, but $93 million already in just 4 short months. It's got a lot of room that it's growing with. Now, the active execution risk, now that's definitely right there. That is requires that precision timing and his execution of those daily 0 DTE trades. Now, the income may be volatile. That those income may fluctuate with the volatility of the market, or even with the lack of volatility of a market. So it's not designed for capital appreciation first. TDAQ is income first, not growth. That's a huge factor to talk about, that this is about income first, and that's very critical. Now let's compare QQQI, the balanced approach, up against TDAQ. So QQQI is designed very differently. It still targets the Nasdaq 100, but instead of daily 0 DTE calls, QQQI uses a more traditional active managed option overlay. The goal here is high income with less day-to-day noise. QQQI typically uses longer date options. It manages upside participation more carefully and focuses on smoother income streams. The yield is still high, often in the low teens, but usually comes with less volatility than TDAQ. Now, QQQI is trying to balance income and portfolio stability. When we pop the hood on this one, we see that you have assets over $8 billion, expense ratio at 0.68, 147 million shares outstanding. Now, I want to say up front, this fund came out January 30th of 2024, so we're almost 2 years into this fund. So the numbers here look very good at 13.69% for the yield and paying out that monthly payout. When you look at the fund on the chart, seeing a 2.64% growth over 12 months, you see that April drop off, you've seen the recovery of it, you've seen the November market rebalance and the recovery from that. So how does QQQI differ from TDAQ? Well, again, option, expirations, you got monthlies versus dailies. Income distributions, you have monthly to monthly, but you got to remember TDAQ has that variable where they're getting money in on a daily basis to reestablish themselves and possibly even put it into more of that SEC 30-day yields that we talk about. And the fund size, you're talking about $8 billion to a brand new hitter at over $93 million. Now, as you know, we always talk about total returns on this channel because we believe those are the most important numbers across the board. And when we take a look at this, we give you the 6-month chart. Now, TDAQ is not a full 6 months in. As I said, they're about 4 months in. So we tried to give you the most comparison that we could. And when you get down to it, the TDAQ is in blue, QQQI is in the tan. Well, 11.18% for QQQI and 9.94% for TDAQ. Now, what I'd say is QQQI is definitely winning this game as of right now. But look at the middle of the screen. Look at that end of October, early November. TDAQ was about ready to bust open over the return of QQQI. Then we had the November market adjustment. And we had the drop off, and you can see TDAQ dropped off dramatically more than QQQI. And now it's come back to recover back to this number. I believe in the long-term run that this has the potential of possibly beating QQQI with just its new short-term run. This is what gives the people the difference in the excitement. Now let's talk about where QQQI really shines and their advantage that they have. They have that smoother income stream. Okay, QQQI uses that longer dated options, resulting in more stable distributions, less sensitive to that daily market volatility. The lower strategy complexity. The active management focus on managing the options overlay with a longer term has reduced the execution errors. The larger fund size, there is no way you can question that. 8 billion versus the 93 million that TDAQ has. So it offers basically more liquidity availability and the proven operating history. Again, we're trying to compare a new guy with an old established, but when you look at total returns, where they're sitting, about equal with each other. Now let's get into IQQQ. This is the structured approach. IQQQ targets at Nasdaq 100, but it leans more to structured, rule-based approach using derivatives and swaps. This can reduce the discretionary manager's risk. It creates more consistent executions and slightly limits its upside in strong rallies. Historically, IQQQ tends to sit between TDAQ and QQQI in terms of risk. So it's not as aggressive as TDAQ, but it's not as flexible as QQQI. So it gives you a mix right in between the two. When we look at them, $358 million on their assets, a little lower expense ratio at 0.55, 7.87 million shares. Now this one came out March 17th of 2024. This one pays out the 4.6 in dividends and a dividend yield at 10.23. So right there, we show the difference. A little more risk, giving bigger yields. IQQQ gives you less risk, but lower yield. And again, we're not chasing yields, but these are a number we have to look at and establish. We look at the 1-year mark, and we see a 4.73% total package growth. As we say, when we look at total returns, look at what they've done. Again, TDAQ is in blue. IQQQ is in the brown. All the way through the patterns, you will see 11.50% on IQQ total return over those 6 months, 9.94 over technically 4 months of TDAQ. Given it the extra couple months, could TDAQ capture and gain on them? According to the charts, the answer is probably no. But you can see they are almost identical to each other and running fairly equal to each other. Again, following the Nasdaq side of it and across the board. So when we put the three funds side by side, TDAQ, QQQI, and IQQQ, each one, as I said, has different strategies. TDAQ is the income maximization higher execution risk. QQQI is the income and smoother profile or portfolio behavior, and IQQQ is structured income with the defined constraints. None of these are bad funds. None of these are the best funds. Okay? It all fits exactly what fits into your risk portfolio. So when we take a look at total returns, you look 11.18, 11.5, 9.94. Okay, those are over the 11 percenters are 6 months. TDAQ is at 4 months. If they got extra 2 more months, would they be up to the 11s? I believe they would be. And we'd have a very good run on our hands. So I always put it this way. These are tools, and you need the tools to match your job. What is it going to take to fit into your needs? So I always get in the fun this one, an investor fit analysis. Where does each one fit? Well, TDAQ may fit if you are an active monitor of your portfolio. If you want maximum income potential, you understand option-driven NAV risk, and you accept the volatility as part of the process. Now, QQQA may fit if you want a strong income and balance, you prefer larger, more liquid funds, and you want a fewer income surprises. And then IQQ will fit if you prefer structural rules over, distraction. You want income without daily strategy noise, and you're comfortable with capping your upside. Like I said, there is no best ETF out there. It's what fits your goals, risk tolerances, and your portfolio role. What do you want these things to do? So the key investment decisions in that framework that we talk about, and this is the one I say, the biggest mistake investors make with income ETFs is they chase yield without understanding the structure. And that's why I always tell everybody, always take a look at total returns. So you can't just be chasing yield. TDAQ is going to have the highest yield, but it has a lot of risk and pieces to it that may not fit everyone. That's why I wanted to share this with you with 3 different ways of covering the Nasdaq 100. And then seeing how TDAQ actually fits in the new stream. And why is it getting excitement? And why are people looking towards it? Because they're different and they're a new operation on the premise. So TDAQ is innovative, but it is aggressive. And QQI is proven, but still income focused. And IQQ is disciplined with less flexibility. So the question it comes into is which fund fits you the best? I'd love to hear that. Which one do you think is the best one for you? And what do you think TDAQ will do in the long run? Leave a comment below. I'd love to hear what you guys have to say about these funds. So my final thoughts is this. The structure over value, and that is structure over yield. The biggest mistake investors make, as I said, is that they chase yield. And you have to understand what each and every one of the funds do. It's matching the right tool with the right piece. And it's a personal alignment with your funds. Now, again, this presentation was brought to you for educational purposes only. This is not financial advice. This is not saying, hey, go out and buy TDAQ. This is not buy QQQI. I don't like TDAQ. This is all about what fits you the best. I want to give you guys the most information and the most up-to-date opportunity that you have. I appreciate you watching. Hit the like button. Hit the subscribe button if you're not part of a membership. And don't be afraid of any of the funds that we show on here. Do your research, understand what they do, and let me know a comment below. I appreciate it.